everybody, and today we'll talk about the financial ratios. Stock investing requires careful analysis of financial data to find out the company's true worth. This is generally done by examining the company's profit and loss account, balance sheet, and cash flow statement. This can be time consuming and cumbersome. An easier way to find it out a company's performance is to look at its historic financial ratios, most of which are freely available on the internet. Although this is not a foolproof method, it is a good way to run a fast check on a company's health. Ratio analysis is crucial for investment decision. It not only helps in knowing how the company has been performing, but also makes it easy for investors to compare companies in the same industry and zero in on the best investment opinion. Here we'll take a look on financial ratios that one should look at before investing in stock. The first one, the price to earnings ratio, shows much stock investors are paying for each rupee of earnings. It shows if the market is overvaluing or undervaluing the company. One can know the ideal price to earnings ratio by comparing the current price to earnings with the company historical price to earnings, the average industry price to earnings, and the market price to earnings. For instance, a company with a price to earnings of 15 may seem expensive when compared to its historical price to earnings, but may be a good buy if the industry price to earnings is 18 and the market average is 20. You must simply search it in Google. So you need to enter price to earnings and then the symbol of the company you are interested in. For example, let's take an Apple company. And as we can see, all data are available, so you can check it by your own. Price to earnings ratio is usually used to value, measure, and stable companies that earn profits. A high price to earning indicates that the stock is either overvalued with respect to history and peers, or the company's earnings are expected to grow at fast pace. But one must keep in mind that companies can boost their price to earnings ratio by adding debt. The second, price to book value. The price to book value ratio is used to compare a company's market price to its book value. Book value is a simple terms, is the amount that will remain if the company liquidates its asset and repays all its liabilities. Price to book value ratio values shares of companies with a large tangible asset on their balance sheet. A price to book value formula ratio of less than 1 shows the stock is undervalued. It indicates a company's inherent value and is useful in evaluating companies whose assets are most liquid, for instance, banks and financial institutions. The debt to equity ratio. It shows how much a company is leveraged, that is, how much debt is involved in the business with promoters' capital. A low figure is usually considered better, but it must not be seen in isolation. If the company's returns are higher than its interest cost, the debt will enhance value. However, if it is not, shareholders will lose. Also, a company with a low debt to equity ratio can be assumed to have a lot of scope for expansion due to the more fundraising options. But it is not that simple. It is industry specific with the capital intensive industries such as automobiles and manufacturing showing a higher figure than others. A high debt to equity ratio may indicate unusual leverage and hence a higher risk of credit default. Thus, it could also signal to the market that company has invested in many high NPV projects. NPV or net percent value is the percent value of future cash flow. Operating profit margin (OPM). The OPM shows operational efficiency and pricing power. It is calculated by dividing operating profit by net sales. Higher OPM shows efficiently in procuring materials and converting them into finished products. It measures their proportion of revenue that is left after meeting available costs such as raw materials and wages. The higher the margin, the better it's for investors. While analyzing a company, one must see whether its OPM has been rising over a period. Investors should also compare OPMs of other companies in the same industry. Enterprise value by EBITDA is often used with the price to earnings ratio to value a company. Enterprise value is a market capitalization plus debt minus cash. It gives much more accurate takeover valuation because it includes debt. In this main advantage has over the price to earning ratio, which we saw can be squared by unusually large earnings driven by debt. EBITDA is earnings before interest, tax, depreciations, and amortization. This ratio is used to value companies that have taken a lot of debt. The main advantage of this is that it can be used to evaluate companies with different levels of debt as it is capital structure natural. A low ratio indicates that a company is undervalued. It is more important to know that the ratio is high for fast-growing industries and low for industries that are growing slowly. Price-earnings growth ratio. The PEG ratio is used to know the relationship between the price of the stock, earnings per share, and the company's growth. Generally, a company that is growing fast has a higher price to earnings ratio. This may give an impression that it's overvalued. Thus, price to earning ratio divided by the estimated growth rate shows if the high price to earnings ratio is justified by the expected figure growth rate. The result can be compared with that of peers with the different growth rates. A PEG ratio is one signal that the stock is valued reasonably. A figure of less than 1 indicates that the stock may be undervalued. Return on equity. The return on equity. The ultimate aim of any investment is returns. Returns on equity or ROE measure the return that shareholders get from the business and overall earnings. It helps investors to compare profitability of companies in the same industry. A figure is always better. The ratio highlights the capability of the management. ROI is net income divided by shareholder equity. A ROI of 15–20% is generally considered good. Those high-grown companies should have a higher ROI. The main benefit comes when earnings are reinvested to generate a still higher ROI, which is in turn produce a high growth rate. One would expect leveraged companies to exhibit inflected ROIs as a major part of capital on which they generate returns unaccounted for by debt. Interest coverage ratio. It is earnings before interest and tax, or EBIT, divided by interest expense. It indicates how solvent a business is and gives an idea about the number of interest payments the business can service solely from operations. One can also use EBITDA, A in place of EBIT, to compare companies in sectors whose depreciation and amortization expenses differ a lot. Or one can use earnings before interest, but after tax if one wants a more accurate idea about a company's solvency. Current ratio. This is show the liquidity position that is how equipped the company in meeting in short-term obligation with the short-term assets. A higher figure signals that a company's day-to-day operation won't get affected by working capital issues. A current ratio of less than 1 is a matter of concern. The ratio can be calculated by dividing current assets with the current liabilities. Current assets include inventories and receivables. Sometimes companies find it difficult to convert inventory into sales or receivables into cash. This may hit its ability to meet obligations. In such a case, the investor may calculate the acid test ratio, which is similar to the current ratio, but with the exception that it doesn't include inventory and receivables. Asset turnover ratio. It shows how efficiently the management is using asset to generate revenue. The higher the ratio, the better it is, as it indicates the company is generating more revenue per rupee cent of the assets. Experts say the comparison should be made between companies in the same industry. This is because the ratio may vary from industry to industry. In sectors such as power and telecommunication, which are more asset-heavy, the asset turnover ratio is low, while the sectors such as retail is high. Dividend yield. It is dividend per share divided by the share price. A higher figure signals that a company is doing well. But one must be wary of penny stocks and companies benefiting from one-time gains or unused cash which they may use to declare special dividends. Similarly, a low dividend yield may not always imply a bad investment, as companies may choose to reinvest all their earnings so that shareholders earn good returns in the long term. Financial ratios analysis help in ascertain factors such as profitability, efficiency, and risk. Added factors such as macroeconomic situation, management quality, and industry outlook should also be studied in detail while investing in stock. For today, that is all. Thank you so much for your attention. Choose your asset carefully and stay safe. See you soon.